I think you have to understand as an investor, take a step back, and as Taylor Swift said, everyone needs to calm down. And, first of all, I think we're in this trade continuum where the administration talks tough on trade, markets sell off. The administration hits at some type of resolution, markets rally, and then nothing happens. And so I think we're in this continuum, and investors need to take a step back and exactly what Jim said, look at company with high quality cash flows. This is an opportunity to step into good companies. And so I think ultimately, we'll talk about the Fed today. The U.S. economy is growing very strong relative to the rest of the world. And so we don't think this is going to put us into recession. It's just more volatility and trade rhetoric.
Is this enough, though? I mean, it seems like a lot is resting on the shoulders of the U.S. consumer. If you take a look at what's going on in Germany, being in contraction, worsening PMIs, the acknowledgement by Fed Chair Powell that global growth is in fact deteriorating. I mean, should we start being concerned about what's going on here in light of this ramp up? Because these tariffs, they might not hit the U.S. Extremely hard, $75 billion worth of goods. So it's kind of limited, but it will hit trade partners. It will hit Europe, for instance, and deepen the crisis there.
When I think about it, I think there's three wild cards to watch. Some are obvious. One is obviously trade, and given that China escalated this morning, it sounds like Trump's going to escalate a little further. And what are the implications of that? Obviously, a wild card on our dashboard. I think the other wild card is the dissension in the Fed and how aggressively are they ultimately going to act? Are they going to be interventionist and give the patient medicine before they actually ultimately need it in the U.S. to treat what's an infection that could spread? I think they probably should do that. I don't know that they do that. I think Powell is kind of threading a needle as it relates to that. And then your point is the U.S. consumer, which still looks really, really strong, but they are a wild card. Oftentimes, this negative news can spill over into the economy through the consumer and paralyze some decision making. But assuming a steady state remains, which is slow growth, low inflation, and a high probability resolution because the motivation is there on all these wild cards, I think you're in a market environment that is probably too cheap. There is no alternative to equities in that environment, despite these risks. I met with Lee Cooperman, a friend of all of ours, on Wednesday, and he asked me a question. He said, Rob, what is the right multiple when yields are negative pretty much around the world for stocks? And he said, is it 20? Is it 30 times earnings? And I don't know if it's 17 times. I think it's ultimately higher than 17 times
so
if you don't get a recession. Higher than we are right now if you don't get a recession. And that's the big wild card. One of these things could throw us into a recession.
Is this all enough to keep you bullish, Tom? Are you just as convicted as you were a month ago, let's say?
Yeah, I mean, I'd say we're still bullish. It's a tough day to be bullish. I would say the biggest change in 2019 versus our baseline is I think there's a real change in the environment for interest rates, and that's what needs to be repositioned. I think lower interest rates ultimately is really good for consumers. So I do think if you're a U.S. equity investor and you're overweight things tied to the U.S., it's really constructive. But, I think there's just a lot of macro risk.